Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the deep dive. If you've been keeping an eye on the global economy, the first half of 2025, you know it's been, well, quite a ride.
Definitely volatile.
Yeah, fascinating, really. We've seen confusing tariff policies pop up, creating uncertainty, and then big tech just pouring hundreds of billions into AI infrastructure.
Unprecedented levels of investment there.
Exactly. And meanwhile, global M&A is actually up maybe 15% more towards strategic deals, but we still have, persistent inflation. OECD is projecting, 4.2%?
Still quite high. And regional conflicts aren't helping stability either.
It's a really complex picture. But amidst all that turbulence, we found this really interesting counter-narrative, a pocket of unexpected resilience.
Holding steady, even strong in places.
Right. We're talking about the middle market, and specifically the lower middle market.
And that's exactly where we're focusing this deep dive today.
Yeah.
We want to zero in on the trends shaping M&A, specifically for IT services and digital marketing firms in that lower middle market space.
Okay, so define that for us, lower middle market.
Yeah, generally we're talking about companies with an enterprise value under, say, $60 million. That's their total value. Equity plus debt.
Got it.
And what's really remarkable is why this area seems to be defying some of those broader headwinds. It's not just that they avoid the issues plaguing bigger deals.
There's more to it.
I think so. Often it's rooted in the kind of indispensable specialized services these firms offer. They become must-have acquisitions, even when times are uncertain. Less discretionary than some larger plays.
Okay, so our mission today is pretty clear then. We're going to unpack the dynamics driving this activity.
Figure out what buyers are really looking for, what commands value.
And pull back the curtain on how deals are actually getting done, how they're thriving in this environment.
Exactly.
And for a lot of our insight today, we should mention we're drawing heavily from the expertise of IT ExchangeNet. They're a global M&A consultancy that lives and breathes this specific segment.
Yeah, they have a really valuable on-the-ground perspective on these trends.
So let's start by digging a bit deeper into that resilience you mentioned. It's such a stark contrast to the large cap market where deal volume actually went down.
It really is.
What is it about the lower middle market specifically? Is it just being less exposed to capital market swings, or is there something else making these deals nimbler?
Well, it's definitely multifaceted, I think. They are less exposed to that kind of capital market volatility that hits the really big deals.
Because they don't need massive public debt or equity.
Precisely. They're not reliant on huge syndication. These transactions can often close with less complex financing structures. That makes them inherently more nimble.
Okay.
You kind of avoid the big swings in market sentiment that affect whether large-scale capital is available or how much it costs. Deals can move forward even if the big banks are tightening their belts.
Right. That makes sense. So if that's the underlying stability, who's actually driving the deal flow? Is private equity still the main player here?
Oh, absolutely. Private equity is still the undisputed main engine in this space.
Still. Even with everything else going on.
Yep. And they're not just sitting back. They're focusing on solid platform investments and then pursuing pretty aggressive roll-up strategies.
Roll-ups meaning buying smaller companies to add on.
Exactly. Add-on acquisitions are particularly common, especially for scaling up existing IT or digital marketing platforms. It's a very disciplined approach. A PE firm buys a core platform company.
Okay.
And then systematically snaps up smaller specialized firms.
Yeah.
Integrates them. Expands the service offering, grabs market share. It creates this consistent demand pipeline.
That tracks. But, if the overall market feels volatile, how can we be sure buyer demand in this specific segment is really holding up? Is it just a feeling, or is there hard proof?
That's a fair question. And no, it's definitely not just anecdotal. We're seeing pretty compelling, tangible evidence.
Like what?
Like the sheer volume of executed non-disclosure agreements, NDAs, that firms like IT ExchangeNet are processing.
Ah, okay. NDAs signal serious intent.
Exactly. When a buyer signs an NDA, they're committing to taking a serious look under the hood at the financials, the operations. Seeing such high volume consistently across different niches within the lower middle market, it just confirms that strong, sustained investor interest is definitely there.
So the appetite hasn't really waned.
It seems not. It's translating into concrete steps towards getting deals done.
Interesting. So if you're running one of these IT or digital marketing firms, or maybe thinking of investing, what's driving the premium valuations right now? What really moves the needle?
Okay, top of the list, without a doubt, is demonstrable AI integration.
Demonstrable being the key word there.
Yeah, absolutely. Buyers are, let's say, no longer impressed by just vague claims, AI-powered this or that, or buzzwords on a website. They want substance, verifiable impact.
So what does demonstrable actually look like in practice?
It means AI that's truly embedded in what the company offers, and crucially, delivering measurable business value.
Right, not just tech for tech's sake.
No vaporware here. It's about seeing how AI drives real outcomes. Maybe it's operational efficiency, automating a complex workflow perhaps, or optimizing resource allocation to cut costs.
Okay.
It could be providing advanced analytics that genuinely lead to faster, better decisions for their clients. Or maybe strengthening cybersecurity in a way you can actually quantify is better than old methods.
Tangible benefits.
Exactly. So firms that can show credible AI roadmaps, point to real-world use cases, and this is critical, prove the results. Maybe a measurable drop in client churn or a faster time to value for their services. Those are the ones commanding premium valuations.
So it's moving past just having AI features to showing an AI-driven ROI.
Got it. That's what really makes a company stand out today.
That's a huge differentiator. And this focus on real value, maybe just the pressure to get deals done, seems to be driving creativity elsewhere too, like in how deals are structured, especially with credit markets being tighter.
Precisely. Acquirers are definitely getting more creative to navigate that.
How so? What kind of mechanisms are becoming more common?
Well, to bridge valuation gaps or just to make deals happen efficiently, things like earnouts, equity rollovers, and seller financing are becoming much more prevalent.
So these aren't just last resorts, they're strategic tools now.
Very much so. They're sophisticated tools that help align interests between the buyer and the seller, which is, crucial. Take an earnout.
Right, where payment depends on future performance.
Exactly. A chunk of the purchase price is paid out later, but only if the acquired company hits specific targets after the deal closes. It reduces risk for the buyer.
And keeps the seller invested in success.
Right. It incentivizes them to stay engaged, ensure growth continues. Then you have equity rollovers.
Where the seller keeps some skin in the game.
Yeah. The seller retains a percentage of equity in the new combined company. Again, aligns their long-term interests with the buyers. And seller financing.
The seller helps fund the purchase.
Correct. The seller essentially provides a loan to the buyer, often used when traditional bank lending is a bit tight or maybe too slow. These strategies, they help preserve cash flow for both sides, and they accommodate those sometimes different expectations about future growth or performance. In this competitive lower middle market, being flexible on deal structure is kind of critical for keeping momentum.
And despite all these economic pressures and the need for creative structuring, when you look at the really high-quality IT service and digital marketing firms, the valuation multiples themselves seem to be holding up remarkably well.
They really are for the strong players.
It underscores their value, but
Yeah.
Are there any signs these multiples are getting stretched, maybe unsustainable?
It's a valid concern, but for the high-quality, truly differentiated firms, the numbers are still robust. For software companies, we're often seeing valuations somewhere in the range of 2.0x to 4.0x revenue.
Okay.
And for those differentiated service firms in the lower middle market, the multiples typically range from, say, 4.5x to maybe 9.0x adjusted EBITDA.
And just to remind folks, EBITDA is basically operating profit before financing and some non-cash items?
Right, gives you a cleaner view of operational profitability. And what drives these healthy multiples? It's a mix of things.
Right.
Strong recurring revenue streams, obviously. High client retention stickiness matters. Genuinely embedded AI capabilities, as we discussed. The right kind of revenue mix. A clear growth path. How scalable the business actually is. And, the depth of those customer relationships.
So fundamentals still matter.
Absolutely. Strategic buyers, especially, are willing to pay premiums for firms with sticky contracts, deep industry specialization, and data-driven services. And that premium only goes up when AI is integrated, effectively blunting efficiency or personalization or automation. It's about real value drivers, not just hype.
Okay, so we've covered the what buyers want and the how deals get structured. Let's shift to the where and the who. Geographically, North America seems way out in front.
Yeah, definitely leading the pack.
Accounting for, 45% of M&A deal volume? That's way ahead of APAC at 26%, EMEA 23%, LATAM only 6%. Why is North America so dominant here?
Well, North America's lead isn't really an accident. It's a confluence of several powerful factors coming together.
Such as?
You've got much deeper capital markets here. Funding is just more readily available. There's a highly mature private equity ecosystem. Decades of experience finding, buying, and growing these kinds of businesses.
Right. The PE infrastructure is well established.
Exactly. Plus, we're seeing really strong digital transformation tailwinds. Businesses are being pushed to modernize faster and faster, creating huge demand for IT services.
And regulation.
Generally favorable regulatory conditions compared to some other regions, and just a large concentration of high-growth, tech-enabled companies that naturally attract buyers from all over the world. It makes it fertile ground.
And it all circles back to that consistent deal flow we talked about, driven by the need for automation, data integration, AI.
Yep, all those core drivers.
Plus that demand for scale and specialization. Buyers want to offer integrated, data-driven solutions. Clients increasingly expect a sort of one-stop shop. Makes sense.
And what's also fascinating is the who behind many of these target companies, especially in the lower middle market.
You mean the sellers?
Yeah. Many of these businesses are founder-led or bootstrapped, grown organically over years, maybe decades.
Built on hard work and client relationships.
Exactly. Often without the, formal corporate structures you see in larger companies. And that makes them incredibly compelling opportunities for acquirers.
What compelling? Less baggage.
Partly, maybe. But also, acquirers see untapped potential. Potential for professionalizing the business, accelerating growth with more resources. This steady pipeline of privately held companies looking for succession options or growth capital. It's a huge contributor to the activity level.
So a continuous supply of good targets coming to market.
It seems that way.
Okay, to make all this concrete, let's look at a real-world example you mentioned from IT ExchangeNet's work. The acquisition of T4S Partners, based in Denver.
Right. By Conchi Technologies or KT2I.
This seems like a perfect illustration of these trends in action.
It really is a good case study. IT ExchangeNet acted as the exclusive sell-side advisor for T4S.
Okay.
And their role really highlights how a targeted process, leveraging a big curated network, they have over 90,000 global buyers in their network, apparently.
Wow, that's extensive.
It is. How that can generate strong competition and get a good outcome for the seller. But beyond the deal mechanics, what's really instructive is why T4S was so attractive.
What made them stand out?
They exemplified exactly what buyers are prioritizing right now. T4S had deep domain knowledge and real cloud expertise. They were positioned right at that intersection of cloud enablement, data strategy, and enterprise agility.
Key areas for modernization.
Exactly. They showed they could deliver measurable impact, accelerate that modernization journey for clients. Especially important now as AI becomes such a board-level imperative.
And we actually have a quote here from Rob Ash, the president of T4S. He said, IT ExchangeNet ran a thoughtful, methodical process from start to finish, socializing our story to the right people and keeping momentum every step of the way.
That's great feedback.
He added, their access to over 90,000 global buyers and ability to position T4S strategically made all the difference. That really underlines the value of that specialized approach in this market, doesn't it?
It really does. It shows how critical it is to clearly articulate a company's unique value, especially if you're playing in those hot areas like cloud, data, and increasingly AI enablement.
Okay, so let's try and wrap up this deep dive. The core message seems pretty clear. Despite all the global economic noise in the first half of 2025.
The uncertainty.
Right. The lower middle market, particularly in IT services and digital marketing, has shown incredible resilience.
It really has held up well.
Private equity is still a major force pushing deals forward. And businesses that can show real, tangible AI value or are open to those creative deal structures we talked about, they're not just surviving.
No, they seem to be thriving, commanding strong interest in valuations.
And looking ahead, what's the longer-term view?
Well, the outlook for this segment seems to remain pretty optimistic, actually. You've got demographic shifts like founders looking to exit, Continued digital innovation isn't slowing down.
If anything, it's accelerating.
Exactly. And that robust pipeline of founder-led businesses needing capital or succession plans, that will keep driving opportunities. The middle market really does feel like an engine room for M&A.
Constantly attracting investors looking for growth and specialization.
Yeah, both seasoned players and new entrants see the potential there. The fundamental demand for specialized tech and marketing services isn't going away.
Which leaves us with maybe a final thought for you, the listener, to ponder. As technology keeps evolving at this breakneck pace, and more businesses grasp the absolute necessity of digital transformation and AI integration, how will this sustained demand for specialized, agile firms in the lower middle market continue to reshape the global M&A landscape in the years ahead?
It's a fascinating question, isn't it? How these smaller, nimble players might influence the bigger picture.
Definitely something to keep an eye on. Thank you for joining us on this deep dive into the resilient lower middle market.
Been great discussing it.
And a special thanks again to IT ExchangeNet for their invaluable insights that really helped shape our discussion today.
Their perspective was key.
Until next time, keep digging deeper.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.